So thank you everyone for joining us today. It's been the topic for investors, right? Small cap is the thing that everyone is looking at today. But there is a need that we felt that we can add value to investors when it comes to small cap portfolios. And that is where we are launching the fund. There are certain challenges when it comes to small cap fund portfolio construction, which we think that we can, do a differentiated offering. And so I will run a few slides to tell you what we are seeing in this space, what is the opportunity, what are the risks, and how we as Quantum can address those risks and opportunities in a bigger way, and therefore add value to investors.
The button is meanwhile we can start.
उसको पहले इसमें एक करिएगा
किस
स्लाइड चेंज में आप ये करिए उसके बाद ये होगा
कैन यू डू इट आप कर सकते हैं स्लाइड चेंज करना
इसको स्लाइड चेंज में करिए
ये है ना लगा हुआ है
इसको ऑप्शन को स्ट्रेट चेंज में करिए नहीं तो ये काम नहीं करेगा
Sure. So just to begin with, today is the day when we start with the NFO. Today is the first day of the NFO, and it lasts till 27th October, where we will receive the subscriptions from investors. So just want to give you a brief background of Quantum as an organization, right? So Quantum is not a new company. Quantum started its journey in 1990 when it was set up by a gentleman called Ajit Dayal. It was set up as a first equity research house in India. It was one of the first equity research house, means institutional kind of research. We were the pioneers of doing that in Indian markets. 1992 was when FIIs were allowed in Indian markets. And that is when, one of the first FIIs that came into Indian market was Jardine Fleming. And they had, that Jardine Fleming was out of UK. And they had our joint venture with Quantum called Quantum Jardine. And that is where we had three businesses. One is asset management, investment banking, and broking. So we were part of the asset management arm of that overall. And till 1995, we had that partnership with Jardine Fleming. And there were certain reasons, ethical reasons why we broke that partnership in 1995. And post that, we have been advisors to many of the foreign firms investing in Indian markets. One of them being Prolific India Opportunities Fund, which was bought out by Aberdeen out of Singapore. And now it is Aberdeen India Opportunities Fund, even existing today. We also were advisors to Walden Nico India Ventures Fund, which was a venture capital fund in 1995. We were also had a good tie-up with a firm called Hansberger Global Investor. Hansberger Global Investor was a firm which was the original pioneers of value investing. If you know Templeton Group, Templeton Galbraith Hansberger was the original name before Franklin took over that firm and became Franklin Templeton. So we were, part of the global universe that looks at investing in Indian markets, and we were all across there. In 1997, when we had the tie-up with Hansberger Global Investors, our founder Ajit went to the US to become deputy CIO at Hansberger Global, and we were managing a fund called Vanguard International Value Fund, which was a $2 billion fund during that time. And it is running even now, but we don't have any tie-up as of now, but from 1997 to 2004 is what we managed for that fund. In 2006 is when we launched the mutual fund in India, and actually 2004. 2003, if anyone remembers, SARS happened in China. What we saw COVID in 2020, a similar kind of thing called SARS happened in 2003, and all markets went down, tanked down significantly. India market was trading at a PE of 8. Today it is at PE of 23. That time it became so cheap, it was trading at 8 times price to earning. So we said that this is an excellent opportunity to do something in India. And therefore Ajit came back in India, and we started managing money as a group for foreign international investors investing in Indian markets. So since then, we have been managing for various FIIs that come into India, mainly the large global firms investing in India like pension funds, sovereign wealth funds, foundations, endowments, etc. So we have been, even today, managing money for them as at the parent level. And at the mutual fund level, we are catering to various Indian investors, retail investors, high net worth, etc. Since we launched in 2006, we have launched very simple suite of products. Very simple, no confusion, simple line of products, no duplication. So when the SEBI categorization rule came, we did not have to shift funds. We had funds in each of the categories that were there. So we had very clear kind of products, and therefore no need to really categorize where this fund will fall. We had really very little rules for that. Also in 2016, if you know Fairfax out of Canada, anyone knows Fairfax as a group? Fairfax owns the Lombard brand, like ICICI Lombard. So they own that Lombard brand. And they have been big investors in Indian markets. They own Thomas Cook, Westcott, those kind of firms. And they bought a stake in Quantum in 2016. They own 49% of the company, and 51% is held by Ajit and the management team. So overall, at the parent level that I spoke about, we manage about 18,500 crores roughly for these foreign investors into equity markets. We are registered with SEBI as a portfolio manager as well, and with various global regulators like SEC, many of them in Canada, etc. And what we want to do is build a highly respected India-focused multi-asset management investment firm. So overall, what advantage that you get with Quantum? So there is two sides of, people generally or investors generally focus on returns, but there is a different side to it which is called risk, right? So we think that for given risk, we will always generate a sensible rate of return for investors. It may not be the highest, but it will not take over risk. If you take over risk, then you can get higher return. But the flip side is not true. That if you take risk, you will definitely get returns. So our thing is to minimize risk for investors, at the same time earn them a sensible, reasonable, good rate of return for their investments. We have a very robust investment process. If you don't have good investment process, if you don't have good research, we will not launch those funds. Very clear. We are investor first, investor centric. We prioritize investors, and we are very consistent when it comes to our track record investing style. This is what you see, really the track record, right? In terms of, if you see blue line is our actual NAV, and the orange line is what we forecasted what our NAV would be. How do we reach this orange line? How do we target price? And what is the current price to target price is your return that you make on your investment in that stock. And when you kind of add it up at the portfolio level, you come out with a portfolio upside. So orange line is nothing but the upside that we have projected 2 years out. And if you see the blue line really tracks the orange line, right? What we predicted and what was in reality is actually the same thing. So if you see, barring these periods, right, barring the period of 2008 or be it the COVID period, there is a big gap, and those are global business locations. For Indian markets were disrupted, not the economy. So if you see, barring those periods, we have really tracked that price very well. So that tells you that, there are 4 P's that investors should see in a manager, right? What is the philosophy? Who are the people behind it? What is the process that they have? And what is the performance, right? We think 4th P is not the performance, but it is the predictability of performance, right? At any given point in time, we know what is the upside on the portfolio. what is the upside we'll make. And this is a track record of what we predicted and what was the upside in reality. It almost matches. This is the team that we have. I am the Chief Investment Officer and have a very able, experienced team to back with. Hitendra Parekh is there in Quantum since 2004, have 3 decades of experience. He's the manager of passive funds and the chief dealer at Quantum. George and Christy manage the value fund at Quantum. Then we have Pankaj, who heads fixed income, who's there in Quantum since last 10 years. We have Ghazal Jain, who heads alternatives, gold, commodities, etc. We have Sneha Joshi. Sneha is there with us here today as well. She's from Pune, so she is amidst all of you. And she's been with Quantum since 2015, 8 years. And we have Abhilasha, who's again a Pune girl and is been there with Quantum with a very good experience of 16, 17 years in Indian equity markets. So coming to the topic of today is small cap. Why small cap now? Are we too late to the party? We have already seen a run up in small caps. What's happening in this space? Is there more opportunity? Is there more risk? How are we going to handle the opportunity and the risk, right? So just a small video first.
Investments are subject to market risks. Read all scheme-related documents carefully.
So that really summarizes what we bring to the table in a way, but we will run through a few slides also to explain it much better. So if you see SEBI classification today, right? SEBI has categorized the top 100 stocks as large caps, 150 after that as mid caps. So barring those 250 stocks, whatever is there in the universe is small caps. So small caps is a very large opportunity set. So if I see market cap from 400 crores to 21,000 crores, small cap starts is about 1,374 stocks. So it is a very, very large universe that exists in small caps. And large universe means a large opportunity set, right? Do you agree with that? Is large universe means large opportunity set? Yes. Of course, another thing, large opportunity set not only from number of stock perspective, but also from a number of sectors perspective. If you see, the large cap universe is very, very skewed. Top 3 sectors, finance, IT, oil and gas, is 65% of the large cap universe. Just 3 sectors. Whereas if you see, there is some skewness in small caps, but not relatively very less as compared to what you see in large caps. For example, finance, which is 40% of the large cap index, is only 14% of the small cap. Certain sectors where, when the economy does well, there is a lot of things happening on the ground. So capital goods as a sector becomes very, very important, and which is 15-16% of small cap, only 5% in large caps. Certain sectors like healthcare is also becoming very, very important given the under-penetration that we have. Number of hospital beds, number of doctors in India are very, very low and has to increase significantly from here. It's 8% of the index versus 1.6 in healthcare in large caps. Also, so given it's relatively less skewed, also it gives you an opportunity to invest in new sectors, which are budding sectors, emerging sectors of tomorrow, which are not present in large caps. For example, agriculture, tourism, transport services. Do you know that we rank very high when it comes to logistics cost in India as compared to any other emerging or global economy? When it comes to logistics cost, it's just nothing but the cost of transporting goods from one place to the other and warehousing cost, storage cost. Right? We have a very high cost despite, land cost not being so high, etc., labor cost not being high, still we have one of the highest costs in the world. So given that there is emphasis that the economy has to grow, that movement of goods and services need to take place very smoothly and the cost need to come down. So government is also emphasizing on transportation costs coming down, and therefore they have a lot of emphasis on doing that. And when they have a lot of emphasis means there is going to be a scale coming through. And when that scale comes through, the sector is going to expand. So overall, niche businesses is where you get opportunities and which are there in small caps, not in large caps. Also, if you see from an opportunity perspective, these companies are under-researched. Do you know how many big institution brokers are in country? About 32. And how many cover large caps? Any guess? All 32 cover large caps. And small caps? Out of 32, how many? Just 8 cover small caps. So about a fourth of brokers that cover large caps cover small caps. So that is why it is very, very under-researched. These are unexplored to an extent. There is information asymmetry in that segment, which gives you that opportunity to identify those companies early on and therefore compound your wealth over the long run. Also, they are under-owned. If you see ownership of these companies, when it comes to institutional ownership, like mutual funds, FIIs, DIIs, owning these kind of companies is very low. It could be 5%, 10%, 15, 20% at the max. Whereas if you see the large cap companies, it goes as high as 50, 60% ownership by the institutions. Also, there is room for PE re-rating. There are 2 ways in which a stock can make you money. One is earnings growth. As the earnings of those companies increase, your stock prices may go up. Second is PE re-rating. PE re-rating means, say, if there's a company which is trading at 10 times PE, for example, right? It is unexplored, under-researched, and therefore it is trading at a low multiple at 10x. When it showcases consistent growth, when it showcases consistent return profile, investors will say that, this is worthy of a higher multiple. Large cap in this category is trading at say 25 times. In this segment, small cap segment, at least pay 15 times, 18 times, 20 times for these businesses. And when that happens, because of the consistent return profile of those companies, investors are willing to pay a higher multiple for buying that. And that is what we call as PE re-rating. So in a large cap segment, usually the returns come from earnings growth only. PE re-rating usually doesn't happen because these are known companies, mature companies, and therefore there is less scope for PE re-rating. Whereas in the small cap space, it's earnings growth plus the PE re-rating story that you can get advantage of. And these are very, very innovative businesses. They have created a niche of themselves. They are early mover, and therefore there is a moat which that helps them scale and avoid competition in a bigger way. With opportunities, there are risks. There is never a single side of things. When with returns, there are risks. With opportunities, there are risks. What is the risk in small caps? That, given the scale of these companies is very low, given they are lesser known companies, they will be finding difficult to attract the best talent. They will find it difficult to attract capital, and that becomes a hurdle for the growth that they want. Also, when it comes to smaller companies, given they have lesser histories, we don't know how promoters will behave in different time periods, different economic cycles, and therefore the governance risk is high in small caps. So why quantum small cap? What are we seeing from a portfolio construction perspective? That was a macro story that we saw. There is a potential for small caps. Now coming to nitty-gritties, looking at the micro, right? So the universe is growing very fast, right? The 250 first stock is where the small caps start. That 250 first stock, whatever it was 2,500, 3,000 crores in 2008, 9, 10 period. Now that 250 first stock where small cap starts is 21,000 crores. So overall, the market caps of these companies are expanding. These companies are getting bigger over time. Also, if you see meaningful companies from 1,000 crores to 8,000 crores is about 900 plus stocks. Right? All this meaningful. Even if I remove the smaller companies, very small companies, still I have about 900 companies in this segment, about 1,000 crores of market cap. Now, what is the problem that we see in the industry today? There are 24 funds, small cap funds in India today. If I take the total AUM, which is around 1.8 lakh crore, the average AUM comes to 8,000 crore. So 1.8 lakh divided by 24 is about 8,000 crores. Out of these 24 funds, what is the average portfolio size? Is 80 stocks. 80 stocks portfolio in each, right? Roughly on average. An average weight is just 1.25%. Now what is the problem is, as the size of these funds have grown, they have increased the number of stocks in the portfolio, right? So what was there, a 100 stock portfolio with 1% average weight has become 200 stock portfolio with 0.5% weight. So what you thought was earlier, they have changed characteristics. So what you saw of the earlier track record is no longer true because the number of stocks have gone up so much that they have deviated from the style. If you see number of stocks with less than 1% weight here is about 60, 70, 90% even. So they have stocks with less than 1% weight, which is a high portion of the portfolio, which means, according to us, is over diversification. It is leading to very suboptimal positions in the portfolio and overtly diversified portfolio. And therefore, the returns, the future returns may get compromised to an extent because of the size that has increased for these funds. Also, what we see is a liquidity problem. What we define as a good liquidity is any stock that can be liquidated in 3 months' time. 3 months' time will be 66 trading days, right? 22 trading days in each month. There were 66 trading days in 3 months. And whatever can be liquidated in 66 trading days, assuming you are 1/3 of the market. You can't be the full market, right? You cannot be the only seller. There will be other sellers also. So assuming you are 1/3 of the market and you take 66 trading days to liquidate the portfolio, so many funds have 60, 70% of the portfolio they cannot sell in 3 months' time. 60, 70% is illiquid portfolio. And also, if you see the funds where liquidity is better, they have changed from being small cap to large and mid to an extent. So if you see, this is in the top 10 holdings of theirs. So either we see a liquidity problem or we see they changing, moving more into large and mid from small caps. 46% in the top 10 is large and mid stocks, not small cap stocks. So we see two problems, liquidity, and second is moving from the mandate of small cap to being more large and mid cap. And also, if you see in the top 10, what is the least liquid holding that they have and how many days that will take to liquidate. It is 150, 200, 500 and even 1600 days to sell that stock given today's liquidity. And we are in a bull run. We have seen increase in liquidity over last 1-2 years, and despite that high liquidity, they will take about 500, 1600 days to liquidate those positions. Is it good or is it bad? Good? It's bad, right? It is very, very illiquid. Also, if you see, what is the problem that we're seeing is, they have, of the portfolio, they hold around 0.5, 0.6% of the portfolio, but they are 8-9% owners in that company. So they have suboptimal portfolio, plus they have a very high ownership in those companies, and they will